All right, we're diving straight in because a major US regulator just completely redrew the map for the entire crypto market. Seriously, a brand new line has been drawn in the sand, and where your portfolio stands on that line, well, that could define its future.
Now, just take a second to really let that sink in. This isn't just some feel-good headline. We're talking about official recognition at the federal level. A major U.S. regulator just carved out an official, albeit cautious, pathway to plug certain digital assets directly into the traditional American financial machine. This is a big deal. So here it is, the main event. The Commodity Futures Trading Commission, the CFTC, has officially hit the launch button on a digital asset pilot program. In plain English, they've given the green light for a select few digital assets to be used as margin collateral. We're talking about the high-stakes, big-money world of derivatives trading. This is a massive step forward.
And this is absolutely the most crucial part, this wasn't an open invitation. The CFTC was incredibly selective, and in doing so, they created an instant hierarchy. So in the approved corner, the new cool kids table, we have Bitcoin, Ether, and USDC. And in the other corner, well, pretty much every other altcoin out there. Think major players like XRP and SOL, now stuck in a regulatory gray area, a very risky limbo for institutional money.
And you can bet the market's reaction was immediate and honestly pretty chaotic. This new hierarchy didn't just create some theoretical divide on paper. No, it triggered a very real, very fast rotation of capital as money began fleeing these newly defined riskier assets and chasing the few that either had that new regulatory stamp of approval or had their own powerful, independent stories to tell.
And wow, this chart just perfectly illustrates that chaos. Look at the difference here. While major altcoins like Solana started to bleed, you had these outliers with really strong internal narratives just surging. Terra Classic popped off because of a major upgrade vote. Zcash soared after a new dynamic fee proposal. So you see, money wasn't leaving crypto. It was just getting very, very specific about where it was going.
And if we drill down, you see the full picture. Bitcoin is kind of struggling to hold its ground. XRP is in a tough fight to hold support at $2.08. But the real story, the one you need to follow, is the flow of capital. It's moving with almost surgical precision into these narrative-driven assets, while the broader mid-cap altcoins, the ones without that regulatory clarity, are taking a serious hit.
Okay, so this brings us to the single most important takeaway from this whole thing. If you only remember one concept from this explainer, please make it this one. It's the one word that really defines crypto's new reality.
Segmentation, that's the word. This is the official regulatory separation of crypto into different classes. You can think of it like this. You now have a premier league of institutionally approved assets, and then a second division of higher-risk, unregulated ones. For the big money, for the institutions, this creates a clear pathway to invest, but only for a select few.
So, this is the million-dollar question, isn't it? What does this new two-tiered market actually mean for your strategy, for your portfolio? The consequences are immediate and, frankly, incredibly high stakes, especially with what's lurking right around the corner. Because, as if that regulatory bombshell wasn't enough to deal with, the market is now staring right down the barrel of the single biggest macroeconomic landmine of the entire month. The next 48 hours could trigger a massive, massive wave of volatility.
This timeline really puts it all into perspective. It's been a whirlwind. On December 8th, boom, the CFTC drops the news. The very next day, the market starts this violent segmentation process. And now, on December 10th, the Federal Reserve's FOMC is set to announce its interest rate decision, right smack in the middle of this incredibly fragile setup.
The key level everyone is watching is $90,000 for Bitcoin. Analysts are calling this the danger zone for a reason. It's a huge psychological and technical support level. In a market that's already feeling drained of liquidity, a macro shock right now could easily shatter that support and trigger a whole lot of selling.
So really, it all boils down to a pretty binary outcome. If we get a hawkish Fed, meaning they sound like they're going to keep interest rates higher for longer, that could easily push Bitcoin below that $90,000 cliff, and altcoins would face an absolutely brutal crash. But on the flip side, a dovish or softer Fed could see Bitcoin rally and challenge that overhead resistance. It is a true knife's edge.
Okay, but let's zoom out from the immediate danger for a second and talk about the new playbook, because this ruling isn't just about some short-term volatility. No, this has fundamentally altered the long-term structure of the entire market.
The new institutional reality is becoming crystal clear.
This CFTC decision basically creates a protective regulatory moat around Bitcoin, Ether, and USDC. This gives traditional finance the clarity they've been waiting for to commit serious capital. And we're already seeing the ripples, with BlackRock filing for a staked ETH ETF, just reinforcing Ether's status as a certified big dog in the space.
And some of the major players out there believe this changes literally everything. Bernstein Research came out with this incredibly bold call, declaring the traditional 4-year Bitcoin cycle dead and predicting a $1 million price target. They see this institutional green light as a complete and total paradigm shift.
Which, of course, leads us to the final critical question. If institutions are now funneling all this capital into just a handful of approved assets, what on earth does that mean for the thousands of other coins out there? Let's take a look at the data.
First up, market sentiment. The Fear and Greed Index is sitting at a 22, which is squarely in extreme fear territory. Now, if you're a contrarian investor, you know that maximum fear is often when the biggest opportunities show up. When everyone else is scared, smart money starts looking for bargains.
Second, let's talk Bitcoin dominance. This chart shows Bitcoin's slice of the total crypto market pie, and right now, it's hovering just above a really strong support area at 58.5%. If this level holds and we see a bounce, it means Bitcoin is likely going to outperform everything else, and that could potentially crush altcoin profits in the process.
And finally, who's actually doing the buying right now? Well, this is fascinating. Retail inflows of Bitcoin to Binance are at a record low, just 400 BTC. The lack of FOMO from everyday investors is huge. It tells us that this price action isn't being driven by the usual retail crowd, which makes the market way less predictable and much more institutionally driven.
So, let's end on this provocative thought. With institutions now having a clear, regulated highway for just a select few assets, with Bitcoin's dominance threatening to surge, and with retail pretty much sitting on the sidelines, are we on the verge of a full altcoin exodus? That is the question that now hangs over this new, segmented crypto landscape.